How the capital gains inclusion increase is going to affect incorporated Canadians. We have never had so many calls and emails in the office about taxes than when the government recently increased the capital gains inclusion rate. So this massively affects incorporated Canadians, really affects doctors, actually, doctors and dentists and healthcare professionals, or anybody that has a holding company. The changes to the capital gains inclusion in the 2024 Canadian federal budget will have a significant impact on your tax liabilities and on your overall financial strategy. Hi, my name is Laurent Munier, and welcome to the channel if you've not been here before, and welcome back if you have. So today we're diving deep into the capital gains changes and how they might affect your financial outlook, especially if you're a doctor or if you use a holding company to invest. So capital gains inclusion rate. In Canada, when you sell an asset and you realize a gain, only a portion of that gain is included in your taxable income. This is the inclusion rate. So before these changes, the inclusion rate was 50% for all capital gains, either personally or in a corporation. So that means that half of the gain was taxed at whatever your marginal tax rate is. And then this has been a really beneficial structure for investors, especially those that are incorporated and who use their company to invest. So now, this increase in the inclusion rate means that significantly higher taxes, and it reduces the overall benefit of earning capital gains. So I'm going to focus the rest of this video for incorporated doctors and physicians, just so it's not for everybody. So if you're investing through a holding company, right? Canadian doctors, Canadian physicians have holding companies, and this is a common tool for investing and for tax planning. And it's literally what you were supposed to do for the last 40 years of basic planning. So by transferring retained earnings from your medical corporation into a holding company with using a tax-free intercompany dividend, you can invest in all sorts of assets like stocks or real estate without immediately being taxed personally on those funds. This allows you to keep more capital working for you right away, but there's a nuance. So while this strategy offers immediate benefits, the principle of tax integration could reduce the effectiveness over time. So now let's understand tax integration. Tax integration is key. It's a main principle in the Canadian Income Tax Act. It's designed to ensure that the income earned either as an individual or a corporation is subject to a similar overall taxation. So this helps to prevent double taxation on the same income. So essentially the earnings in your medical corp are taxed at the corporate level, and when those earnings are distributed to you as a salary or dividend, you pay personal tax on that income. So with the dividend, the personal tax credit is available on the grossed up balance, and this makes sure that the combined tax you pay at the corporate and the personal level is basically the same as if the income was earned directly by you. So these changes and their impact. So the changes in the 2024 federal budget that have been in place since June 2024. So the government has increased the capital gains inclusion rate from 50% to 66.6% effective since June. So the change has substantial implications for a corporation, including your holding company, because it makes a larger part of the capital gain taxable. So let's consider this hypothetical scenario. Me, Dr. Munier here. I'm an incorporated physician in British Columbia, and I have a holding company through which I sell my old office. And there's a realized capital gain of $500,000. So under the previous rule, only half of that gain, or $250,000, is taxable, resulting in I'm paying taxes of $133,000. Under the new rules, with the increased inclusion rate, 66% of that is taxable, so $333,000, which raises my taxes to $178,000. So this is a 33% increase in the tax for the same gain. So that's an extra $45,000 in taxes going to Ottawa when Dr. Me sells my office, right? So additional impacts that you really should consider, right? Because these ramifications of the changes don't just stop at the capital gains, right? It could also affect how your passive income is calculated, which in turn influences your small business deduction for all of your connected companies, which would include your medical corporation. On top of that, the tax-free capital dividend account, your CDA, could also have reduced credit, which also further limits your ability to distribute tax-free dividends. So, which all of these things mean you're paying more tax and more tax again. So some strategies that you could consider. So since these changes to the capital gains inclusion rate have been put in place, it's important that you review, and maybe you might have to adjust your financial strategies that were set up under the old rules. So some key steps that you could look at to consider. Number one, you could reevaluate your investment strategies, right? What are you invested in? Would investing in a different type of investment minimize the impact of these changes? Do you have to switch your investment strategy? Second thing you could do, you could maximize your tax deferred accounts. So now tax deferred accounts like your RRSP, your TFSA, those are even more valuable, and it might make sense to max these out even more. You could also consider permanent life insurance. Permanent life insurance policies like a whole life insurance policy or a universal life insurance policy, they've always had a privileged tax treatment, but the accountants and the lawyers could always do things to help lower your tax bill. There was always some planning you could do. Well, the government has taken away a lot of the planning that used to be available. So now life insurance becomes a bigger priority. It's higher up on the strategy list of things to do. Permanent life insurance policies can offer both your estate protection that you need and the tax deferred growth inside your holding company, because the growth of the cash value inside the insurance doesn't count towards the passive income rules and doesn't count as a capital gain if you leave the money inside. Because the life insurance can help with these new capital gains inclusion rules and the passive income rules, so it kind of kills two birds with one stone. That's a lot so far in this video, so I'm going to leave you with some final thoughts. These tax increases are implemented, and they are going to affect incorporated physicians across Canada who invest through their holding company. The changes probably have already had some effect on you as they've been in place for a few months now. And if you haven't already, now is a really important time to talk to your financial team, your insurance person, your investment advisor, your accountant, your lawyer. You might have to make adjustments to your plan based on this new tax rate. If you don't like your insurance guy or you don't have one, we're happy to talk to you and see if it makes sense for you to work with us. If you don't have a plan, we can see if putting a plan together makes sense for you. The best way to get in touch with us is through our website at safepacific.com. You send us a message there, it'll come to us. Somebody from the team will get back to you in 24 hours on business days to set up a meeting time. I know that this is a big subject right now for doctors and for investors and for anybody who's investing through a corporation in Canada. And there's not a lot of information that provides practical solutions to these changes, right? So please do all the algorithm boosters. Click the buttons, click like, leave a comment, subscribe, share. This helps the video to go out to more doctors across Canada, more incorporated professionals across Canada who need help solving these capital gains inclusion rate problems. That's it for me today. Thanks a lot for watching, and I will see you next time.